Hey, today we're going to do a little bit of math. I want to walk you guys through the specifics of how covered calls and our about to be newly introduced cash secured puts can help make us money, and it's pretty shiny, so let's dig in. Hello, hello, this is Pookie's Revenge. We're back with another episode of the $500 5-year Rags to Riches series episodes. Another episode of episodes. All right, let's get my face out of the way. So today we're going to be doing some of the more complicated stuff, and that it's not going to be complicated, but I want to walk you guys through the concepts, and we're going to use a theoretical trade to illustrate how it all works and the difference between average and cost basis, because that's a very, very important concept, especially when it comes to taxes. All right, so this is just two words on the screen. We'll start off nice and slow. So let's just say in this scenario, you were to buy 100 shares of some random stock at $5, and you intend to do a covered call, cash secured put approach on it. Okay. First thing you got to do is buy 100 shares. Now, this doesn't include using a cash secured put to acquire those shares. If it does, you just add that to your credit bucket. Otherwise, let's just assume you bought 500 or $5 shares times 100. So $500 total investment. You now have 100 shares. So right here, you can see I've broken down the positions and the credits all together. So this one says premiums collected. We'll get to the next block here in a second. I just want to inch through this nice and deliberately. Okay. So if you were to buy 100 shares, you would have your dollars invested would be $500. Okay. Your average on every share that you own would be $5 per share. Okay. So your cost basis, if you haven't received any credits or anything like that, if you haven't sold anything, any contracts, your cost basis is $5. Okay. So let's go ahead and look at the, I'll just show you guys what it looks like. There you go. So let's go ahead and stick to round one here. And for round one, it's just a timeline. After we buy our 100 shares, we want to sell a 550 covered call against those 100 shares for a 25-cent premium. Now, assume this is all theoretical, so the numbers won't obviously reflect your real trades, but they should be generally in the ballpark. I tried to guess pretty accurately here. So in this case, you would have then collected a premium. Okay, so this is a credit to your account. It's a separate cash premium. It doesn't count towards your share P&L. And that's kind of the core of what I want to explain. So your average for those 100 shares will still be $5, but your cost basis is reduced by the credit you received. So that brings your cost basis down to $4.75. And what that means is that if you were to close that position, let's say the price went down to $4.50, right? And you were to sell your shares and you were to close your contract, you would keep the $25 premium for the call that you sold, okay? But your shares, okay, they would be separate. Your share P&L would be $5, so your average minus $4.50. So you'd lose 50 cents per share, and that loss would be offset by the 25-cent credit you collected. So your net P&L would be negative 25 cents, or $25 in this case, because you multiply by 100. So you'd lose $25 overall, but your share P&L would show that you've lost $50. Okay, so when it comes time for taxes and stuff, you got to keep track of those two separate numbers. All right. Okay, so in this case, we bought 100 shares and we've sold one covered call against them. We collected a 25-cent premium, and we understand that that reduces our cost basis by the amount of that premium down to $4.75. Okay, so we have our average and we have our cost basis. So this here will just be a chain of your cost basis adjustments over time. All right, let's say the market drops to $4.50. Okay, and we're not going to sell or anything like that yet. We want to keep selling covered calls in this case. All right, so the next step here would be to sell a covered call for 15 cents, so a $5 covered call. Remember, because our cost basis is $4.75, so if we sell a $5 call and we get assigned, overall we're making $25, right? Even though, again, our average on the shares is $5, so if we're selling them at $5, we break even. Okay, so we're making a profit in this scenario, but not on the shares. All right. So in this case, we're just going to move to round two here. So we can sell a $5 call for a 15-cent premium, assumedly. And let's also sell a put for 35 cents. And what a cash secured put does is it sets aside the amount you'd normally need to buy 100 shares, and it sells someone else the right to buy shares. To sell shares. So what you're doing basically is you're placing a limit buy order. So when the price gets down below $4 and you get assigned, you buy those 100 shares at $4 per contract. So it's cool, right? So now we have a limit buy, I'm sorry, we have a fancy limit sell order that we get paid to place, which we've been pretty familiar with. And now we also have the same thing for a limit buy order in case we want to acquire more shares at a lower price. All right, so this is a conjunction you can do at basically any time, as long as you have 100 shares to start the covered call, because you can sell covered or cash secured puts without having the shares. You just need the cash for it, okay? So in this scenario, at this step, right, we're going to focus on the green block here. Your total share quantity at this point is still 100 shares. You haven't been assigned anything. You're just selling calls so far. Total dollars invested is still $500. Your average on all your shares is still $5 per share. And remember, that comes in when it's time for the share P&L. Your cost basis, that gets reduced by the number of credits that you've collected. So in this case, you started at a $5 cost basis. You received the initial 25-cent credit. That brings it down to $4.75. You then received a 15-cent credit for this covered call, and then a 35-cent credit for this put, okay? So 25, 15, 35, that brings your cost basis from $5 down to $4.75, down to $4.60, down to $4.25, okay? Remember, your average is still $5. That's the important part. Okay, so we would then have -1 call, -1 put, and we've had all these credits added to our account, and we still just have 100 shares. And then let's say the market price continues to drop. It drops below $4, okay? The next round would be somewhere, I assume, some sort of assignment, right, for this example. Let's just say that we're assigned on this $4 put that we sold for 35-cent credit, okay? In this case, we'd be forced to buy 100 shares at the $4 strike price. So the first round of shares, the first 100 shares we bought back in step 0 was to buy 100 shares at $5, okay? Now we're buying another 100 shares at $4, okay? And then we can immediately sell a 450 call against those 100 shares because we're acquiring shares, so we can sell another call, all right? In this case, we now have 200 shares, right? Because we bought 100 shares initially, and then we just got forced to buy another 100 shares. That means we have a total investment of $900 and an average of $450, right? So we've taken $900, put it into 200 shares, which means our average is $4.50 per share, okay? Now our cost basis is adjusted. Okay, our average stays at $4.50, and in order to determine the cost basis, you need to know your average, because the cost basis is just your average minus the sum of credits, okay? Just to keep it simple. So in this case, our average is $4.50. We subtract, from $5 down to $4.75, down to $4.60, down to $4.25, off this 25, 15, 35, 40. However, we also need to adjust for the lower average here. So let's go ahead and let's factor that in here real quick. So we've got $4.50, then we've got $4.35, then we've got $4, and then we've got another 40 cents off of that would be $3.60. Okay, so we'll catch up on the math later, but just understand that we're driving our cost basis down into the dirt, and it's awesome. All right. And this was a $4.50 call. Okay, so that means if price goes above $4.50, which is the next step, let's just assume the price recovers and goes back up above $4.50. We then get a sign on the $4.50 calls, and since we have 2 of them, that's why I kind of made this 40 cents. We can double that to 80, but I don't want to do that. Let's just assume that we get 40 cents for the both of them, since it's kind of far out. We would then have to sell 200 shares at $4.50, okay? Which means our share quantity gets reduced to 0 because we're offloading all 200 shares. Our total dollars invested is still $9. Our average is still $4.50, and our cost basis, I have to adjust this over here. Let me just copy. That's not the right letter. There we go. Just got to move this over here. There we go. Sorry, I got to move this down as well. A little bit of housekeeping here, guys. Sorry. Okay, so our average was still $4.50. Our cost basis was still $3.60, right? Because it's the sum of all these credits. But we're actually selling at $4.50, and we're selling all 200 shares. So if we look at this from a numbers perspective, we have collected $25 plus $15 plus $35 plus $40, okay, in credits and credits only. That is in the options bucket. So when you look at your P&L, it's going to be in the options P&L, or if you look under components, I'm sorry. And then since we're selling the shares, we have to rectify the share P&L separately. Okay, so 360. I gotta adjust the numbers over here. So 450 minus 360. So your net sum. Whoops, sorry. Let me just get that out of there. We'll stick with the original numbers just to demonstrate. So your total credits received on this would be $230. Okay, that's all of the credits combined, and then your share P&L would essentially be your average, right? So 450 is your average, not your cost basis, because this, remember, cost basis is the sum of the options credits received. So we don't count that into our share P&L. Okay, so our share P&L is the difference between the average, which is 450, minus the strike price at which we sell, which in this case is 450. So if you were selling below your average, so a $4 strike, for example, you would lose money on the shares. You would realize a loss on the shares, but your net profits would still be higher because of your cost basis. You'd just see the total difference as a net sum, and you'd see a loss in your shares P&L and a profit in your option P&L. So it's very important to understand the difference there between the two. So in this case, you're just adding up all your credits, and then you're taking any difference between the shares, plus or minus, and your average, sorry, the average and the strike price, right? And that is your net P&L that you're going to realize, okay? So it's just split between shares and options at the end of the day. All right, and then you can celebrate because you've done successfully multiple covered calls and multiple cash secured puts. And most importantly, you've found a way to basically average down a position while placing fancy buy and sell orders that allow you to onload and offload shares and get paid while you do it. So if you were to look at, let's just grab a random stock here. So if we look at SPCE, for example, right? We all know that if we want to buy 100 shares, oops, sorry, let me just, we'll just do, yeah, we'll grab SPC, sorry. This is on the smaller account. So let's just say I wanted to buy some shares here, and I wanted to buy some shares here, right? Normally, I would just place a limit buy order, and then when the price came down or came back up, or when the order got filled, right? If I placed the order over here, oops, it's a little hard to drag. Oh well, you guys get it. Anyway, I place an order here. I acquire some shares at 208.8, and then the price drops, and I want to buy some more shares here. So what I could do is I'd place a buy order here, whether it's market or limit order, right? And then we get another set down here that would bring our average to right in the middle. Okay, and that's essentially all we've done. So if I look at this theoretical stock, say this is the $5 level where I bought the first 100 shares. This is the $4 level where I bought the other set of shares. My average is here at 450. So if I sell, when the price comes back up to 450, my share P&L is break even. Okay, but I've collected a profit here, and I've collected a profit here just for selling the calls and the puts. So this is a profit because I was paid to place the order and take that risk of assignment. And here's a profit because I was paid to place that order and risk assignment. And those get added to this at the end of the transaction, or when I calculate my net sum. So this gets added in to that, that gets added into that, and then, whoops, sorry. And then both of these, right, are the net sum of all your profits for that company. I hate this interface. So hopefully that makes sense. All right, let's just look at this one more time, okay? You start off with 100 shares, okay? Easy peasy, you buy them at $5 a share. You then sell a covered call, you collect a premium. Okay, you sell a $5.50 covered call. That leaves you with 100 shares, $500 invested, an average of $5 per share. Cost base is $5 minus the premium you collected when you sold the covered call, which is $4.75. Okay. Market price drops to $4.50. You then place another covered call for 15 cents, and then you also sell a put for 35 cents. You collect those two premiums there. If price goes up, something happens. If price goes down, something happens. If it stays in between, you just keep the premiums and you keep your shares. All right. Now you still have 100 shares, $500 invested, an average of $5 per share. Your cost basis, however, drops from $4.75 down to $5.25 because you picked up these two extra premiums. Let's say the price drops some more, and you can repeat this process as much as you want, as long as the price stays in that range. It's pretty cool. Say price drops below $4, and then let's say you're assigned on the put. You then have to buy another 100 shares, so you spend another $400. So $900 total invested. You now have 200 shares and an average of $4.50 per share. Your cost basis, however, is reduced by that 40-cent credit as well, so it's down to $3.60, right? Because you sold the call against that second set of 100 shares. Now let's say the market price recovers, goes back up above $4.50. You get assigned on your calls. You lose all 200 shares, or you don't lose them. You sell them at the strike price. The strike price can be above or below your average. That determines whether or not you get a share P&L when you realize it. And then your credits are added up and added to the P&L from the shares, and then that's your net P&L. All right, so you're going to have a realized loss or profit on the shares, and you're going to have a net profit and loss on the combined total of these two. All right, that's that. And then this is because you made it to the end. So I'll end this video here because it's a 15-minute one and it's a lot of math. So feel free to re-watch this as many times as you want. And I hope this made sense and made it a little more visually digestible. So I appreciate you guys all watching. I can put a screenshot of this in the Rags to Riches team chat so you guys can have it. And hopefully that demonstrates the process. And again, this piece right here, right? This is the most efficient piece of this whole process, is when you get the price to stay within a range and you could just keep selling double calls and puts. Now, this is only if you want to commit more money to the position. If you buy 100 shares, you just want to sell covered calls against it to drive your price down, your cost basis, and then you can sell lower and lower strikes, just like we did in Neo. If you don't want to commit more money to it, you just don't sell the puts, right? You just keep, you can manually buy some more shares to bring your average down, or you can just keep selling covered calls against the shares you already have and wait for the price to recover. Both are acceptable, but if you're looking to optimize and be more efficient, this is the way. So once the Neo position's out of this larger account, I'll go ahead and do that, and I'll start describing and walking you guys through examples of how to do that. But I wanted to give you guys a primer on cash secured puts because it's that's another powerful tool in our arsenal, and that allows us to effectively harvest theta twice as fast. So if you thought covered calls were good, let's dig into some more. All right, yeah, I'm going to end this episode. I appreciate you all watching, and hopefully you guys have a good holiday weekend. The market's closed today. It's Friday for Good Friday, but we'll be back at it Monday, and also just keep working out. Keep yourself fit. Keep yourself hydrated to the best of your ability, and we'll see you next time. Thank you all. Bye.